In this how-to session, we're going to explore what the potential move from APRA might be after the macro-prudential regulations that they introduced in late 2014. Firstly, who is APRA? APRA stands for the Australian Prudential Regulatory Authority, and their job is to regulate the lenders who lend money out into the marketplace. Now, when you've got historically low interest rates, you obviously have cheap cost of money, and the risk with cheap cost of money is asset bubbles and asset appreciation. So what actually happened in 2014 was the marketplace, especially in Sydney and to some degree in Melbourne and some other parts of Australia, is property prices were moving very, very quickly. Now, we all understand that property prices are set by supply and demand. So when demand is high, but obviously with property, it takes a while for supply to come online, we potentially have this risk where we get ahead of ourselves and we create a property bubble. Now, so what APRA did once they realised that really the RBA had no movement in terms of they needed to keep interest rates really low to try and stimulate business investment, will obviously stimulate jobs and keep the economy growing. So APRA had an idea. Their idea is they wanted to basically shave away some of the demand in the marketplace. And how they did that was this. They focused in on the investment lender. And the first thing they did is they introduced a speed limit. So we talked about that in late December 2014, but really started to introduce that in early 2015. Now that speed limit meant that the lenders couldn't move the amount of money that they were borrowing by greater than 10%. So they couldn't grow their loan book greater than 10% per annum. So that obviously meant that the amount of investment lending coming to them, they potentially couldn't handle. So they had to put a brake on that. Now, how did they put a brake on that? Well, effectively what they did as part of the story, because if you think about the banks, they're a business and they've got to return money to shareholders, and effectively APRA's told them they can operate with one hand behind their back, is that they started to lift investment lending rates. And they argued that the risk was getting higher and the cost of money was getting higher, which isn't really true because when you actually lend to an investment lender, the default rates are actually lower than lending to owner-occupiers. But about that another day. So let's focus on that. So they basically put this speed limit in. Then they looked at the banks in terms of how confident they were around the amount of capacity, in terms of servicing capacity of the borrowers. And they thought that the lenders were a bit too relaxed. So they started to claw back the amount of borrowing capacity people had by increasing what they call the risk rating or the servicing assessment that they were doing. So they did that to again lessen demand. And the final thing they did was introduced interest-only lending, which meant that, in terms of interest-only lending was growing at over 30%, in some cases 40%. So they wanted to bring that down and they said to the lenders, we want to cap that at around 30% or below that. Now that's automatically happened because what we then saw was the price of interest-only loans went up, and that meant that a lot of people switched from interest-only to principal and interest repayments. So that's clearly worked, where we've seen definitely a big reduction and we're now in sort of levels of 10 to 20% interest only in new lending. So it definitely has balanced the book out. Now that's all been well and good, and it has sort of certainly served a purpose in bringing down that level of demand. So as we move through 2018, we are going to see that level of demand start to slow down, and we're definitely seeing more supply come into the market. And that's going to put pressure on property prices. But it's going to be a gradual sort of smooth landing as opposed to any sort of significant correction, which is what they were worried about. So that's why they've introduced this regulation over time, reduced the level of demand, and we're potentially going to have a soft landing when it comes to property prices. But after that point, what if property prices start to slow? What if construction starts to slow? What if the economy and jobs relating both directly and indirectly to the property market start to slow? The regulator is going to have to loosen those grips, those regulation measures, those levers that they've put in place. And if we have any indication of what potentially might happen, we only need to look to our neighbour in New Zealand, where they're starting to ratchet back some of those macro-prudential regulations. So, what is next? What are they going to do? Well, in my view, they've got a couple of choices, and that's going to be dependent on terms of how competition in the lending market works. So if we see some banks start to reduce the margin that they've put in between investor lending and owner-occupied lending, that may increase the stimulus. That may increase more people back into the marketplace. And then APRA may not necessarily need to do anything because the market forces will adjust accordingly as competition gets tougher and tougher for your lending business. So we may see that creep back. Now, if that doesn't happen, we would certainly see APRA start to talk about reducing or removing their 10% speed limit on growing their investment loan book. So opening themselves up to more growth, and that obviously stimulates more competition. Now, hopefully when there's more competition, that means that the interest rates that we as retailers and consumers will pay will actually drop down. One thing I don't think they'll have an appetite to do is to relax the borrowing power for now. I think, ultimately interest rates are going to stay lower for longer, so I think they'll still be prudent in the amount of money that people can borrow, because like most people, they can't trust the broader community in terms of how they manage their money. So that's what we think APRA are going to do next. We think that if they are going to pull a lever, it's going to be reducing that speed limit to try and increase competition. And hopefully what we will see is new entrants coming into the lending market space who are going to offer competitive interest rates for investment lending as opposed to just owner-occupied lending. Now, we know that there will be some challenges there with Basel III. We've seen some new report papers come out about, sort of talking about risks of how servicing calculators are using rental income to assist in that. So you might see a change in risk rating, which APRA will also talk to the banks about. That's a real risk, but I hope to think that competition will win out and lenders will identify that property investors on the whole are a pretty good risk compared to owner-occupiers. So that's what we think APRA's next move may be. So thanks for watching, and if you'd like to check out more of our how-to videos, we have beginner videos, intermediate and advanced videos to educate you in how to invest in property. And if you like what you hear here, make sure you write a comment below.